Hello and welcome to this edition of Earnings Express. I'm your host Nickey Mirchandani. The FY24 Nifty earnings has seen 0.5% of cut thus far during the results season. As for Jefferies, 63 companies for June quarter results that they've analyzed, 43 have come above analyst estimates, same pace as the past 4 quarters, while 33 came below. The remaining 24% were more or less in line with estimates. Earning downgrades were to an extent of 49%, more than the upgrades to an extent of 41%. But let's talk about oil marketing companies. BPCL, which reported an EBITDA growth of 42% sequentially, a large beat on both refining and marketing. Refining GRM came in at $12.6 per barrel, which got help from cheaper Russian support from Russian crude. Marketing gains of around 8 to 10 rupees per litre on auto fuels already declined to rupees 4 to 8 per litre. The capex run rate of 3x for the next 5 odd years. Let's talk about IOC too. Well, revenues were pretty much flattish sequentially. EBITDA was up more than 40%. Bottom line jumped to 37 odd percent. Essentially, IOC numbers were more or less in line with estimates. Petrochem business reported weaker margins. GRMs were lower than estimate at $8.34 barrel versus estimate of around $9.2 barrel out there. In terms of expectation that we have from HPCL, which is going to be reporting in the numbers today, we have a poll out there, which is going to be a CNBC poll. Essentially, the growth that we are looking at, revenue is seen up by 4.5%. EBITDA, a jump of sequentially more than 100%. OPMs are expected, the operating margins are expected to around 8.8% as compared to 4% in the previous quarter, and profitability too is seen higher by as much as 77 odd percent. But to take the discussion forward, we're being joined by Probal Sen, Senior Research Analyst of oil and gas sector overall. Good morning there. What's the read through for the oil marketing companies? Trends shaping up in Q1 between the three OMC's results? Sure, HPCL is yet to report in the numbers. What has delighted you, and also the pocket that you like within the space given the fundamentals and valuations?
Okay, so that's a lot of questions to unpack. Let me start off just the first part of the question. I think the OMC results have obviously been fairly strong. If we look at the marketing margins, which you mentioned, that has been the primary driver of performance. The extent of outperformance can be gauged from the fact that the EBITDA that BPCL reported in first quarter was actually more than what they had reported in the entirety of FY23. And even for IOCL, the EBITDA reported in 1Q was close to about 70% of the overall EBITDA for FY23. So performance has been very strong. And of course, HPCL results, while they are yet to come, today, should also report a fairly strong set of numbers. I think the two key takeaways that we have taken is that if you look at 1Q numbers and compare that to what the street is estimating for the rest of FY2024, very clearly, almost 50 to 60% of the street estimates for annual earnings have come through in 1Q itself. So if and the pessimism around their numbers has been built on the fact that there's a price decrease that people are expecting to come through in petrol and diesel over the rest of the year. But our contention very clearly is that even if you were to build in a much lower margin environment in the second half of the year, FY24 earnings are still likely to be around 15 to 20% higher than what the street estimates would indicate at this point of time. So that is what has driven our optimism around the entire space. We continue to remain, strong. We would continue to recommend a strong buy on all three names, with BP, HP, and IOCL perhaps being the preferred pecking order within this subsegment.
All right, do you think these companies are now re-rating candidates out there given the valuation still remains? Let's talk about the valuation A. And B, do you think given the performance that they have seen already in Q1, which HPCL is also expected to deliver on a similar line as compared to the peers, you think there is a strong case for re-rating of these counters?
I think people will probably look to a more uniformity and probably a more dynamic pricing regime to actually come back. before structurally re-rating these names. One of the things that had led the previous round of re-rating, if you notice, is when daily pricing was introduced and was being implemented in the spirit and not just in letter. And I think that is something that has been missing from April of last year. It's irrelevant in terms of who has decided to hold the pricing, whether the companies themselves or the promoter has indicated or whatever. But the fact is that, till that happens, my sense is that the upgrades that will happen in these stocks will be led by earnings upgrades rather than any structural re-rating of multiples. Valuations, as you rightly pointed out, continue to remain well below historical levels, and that is obviously a source of comfort. But that alone will not probably be a source of a re-rating unless we actually see fuel pricing sort of matching international norms on a real-time basis, as was expected to be the case in from the time that the daily fuel pricing norms were actually put in place. So I think that needs to happen, because even an aspersion or even a perception that there is some sort of regulatory involvement in fuel pricing, whether right or not, tends to have an impact on the way these companies are perceived and basically valued by the street. So I think that is something that we need to change.
Sure, I wanted your perspective on the narrowing discount on Russian crude. Will that more than offset the recent improvements that we have seen on the GRM fronts? And also your view on the elevated crude price narrowing the marketing spreads.
Yeah, okay. So two things. One is that obviously the Russian crude played a big role. If you notice the way that Singapore benchmarks have behaved even in the last couple of quarters and the reported GRMs for the Indian operators, very clearly there's a huge advantage that has opened up over benchmark margins. Two reasons for that. One is that some of the specific product spreads that drove the advantage in the GRMs have a higher weightage for Indian product slates compared to the benchmark product slate. But the more important reason is that Russian crude went up to as much as 35 to 40% apparently in the sourcing mix of some of the players. And given that it was available at a discount of at least 10% to benchmark crudes, that's a straight advantage of sort of $4 that people were making in sort of their GRMs. So any narrowing of that discount or a lower proportion of Russian crude to that extent in India's sourcing mix will obviously have a negative impact on GRMs. There's no question of that. The second part about the narrowing of marketing margins, yes, the crude prices have gone up quite sharply in the last month or so, and product spreads have also sort of improved. But our sense is that we would want to wait and watch a little bit more in terms of what level crude settles in. In any case, marketing margins, while they are narrowing, the average for the first 4 months still is well above the comfort levels for the OMCs. And one has to also look at the fact that at the same time that the margins are narrowing, your refining margins have once again started to ramp up, and that will hopefully offset whatever softer marketing earnings are seen in the second quarter.
Sure, let's just take a little more aerial view. Since we are entering the election year, petrol, diesel prices could be slashed, which in turn will have impact on marketing margins. How are you viewing the second half of the current financial year?
I don't want to sort of get into the political angle of it. As of now, the OMCs have stated that the fuel pricing remains in their hands. So I will leave it at that. But the fact is that given the kind of margins that they are already making, there is a case to be made for a 5 to 6 rupee reduction in any case. We cannot effectively predict the timing of the same as of now. But in our estimates, we are certainly building in a much softer margin environment for the second half. Our annual estimates are still at levels of around 3.5 to 4 rupees versus the 8.5 rupee plus that they made in Q1. So our sense very clearly is that in H2, what we are looking at right now is a much more normalized margin environment where they probably make maybe break-even levels or so. And even on those estimates, earnings are still coming out to be an extremely strong trajectory versus FY23 levels. For IOCL, we expect a 2.5x expansion in annual earnings. For BPCL, I think the number is about 4x, and similar would be the multiple the earnings expansion for HPCL, even on those estimates. So I think that is something that's important to keep in mind.
That's quite a strong performance coming in from the sector, which otherwise was not so talked about. But let's talk about the balance sheet. Despite the capital addition over the last decade or so, it still remains under leveraged. What's your perspective on that?
Yeah, I think, specifically for, if you look at BPCL, in fact, because of the whole divestment process and the fact that projects had been put on hold, in any case, their balance sheet is, fairly comfortable. Even with the kind of capex that has been announced over the next 5 years, we would still expect, particularly now that they're.
All right, looks like we caught up with a bad video. We're trying patch it up again, but right now it looks like a steady set of numbers coming in from the entire oil marketing companies. And the key highlight that remains to be noted is the entire performance of FY23 in terms of the EBITDA is seen in Q1, which is something that the street probably has factored in and is not rewarding the counters right now. But we're going to try and patch up the line with Mr. Sen again, just to get his perspective overall on the capital raising plans, how BPCL has thus far announced it, which HPCL and IOCL follow suit remains to be seen. We were talking about balance sheet and the leverage thus far, given the kind of capital additions that all these players have, suggested right now in the last couple of decades. But let's actually get Mr. Sen back and check with him about what he makes out of the entire leverage and the capital raising by these players.
Yeah, apologies for that. My internet connection was a bit unstable. What I was referring to was that if you look at the leverage in the inherently in the balance sheets of the three companies and the capex plans that they have put in place, I think the improved cash flows over 24 and 25 should actually keep leverage under control. While yes, the capex plans are fairly aggressive, and part of that is being sought to be met by the rights issues that have been approved for BPCL, IOCL, and HPCL, which we believe is a way for the government to actually fund a part of this capex. They had provisioned about 30,000 odd crores in the budget last year as a capital outlay. And at that time, frankly, all of us were wondering in terms of what this was for, since it was very clearly not a subsidy. And I think now that the rights issue, decision is being made clear. So this is obviously going to help fund partly the kind of capex that they have planned. But frankly, at this point of time, I don't think that leverage is actually a major concern for the OMCs, given the kind of cash flows they're making, even with the kind of capex plans that they have announced or are putting in place. So I think particularly for HPCL, in fact, a major part of the capex is already done. So what will actually happen over the next couple of years is that leverage will actually start to improve, despite all of their expansion plans basically getting completed, the Vizag refinery expansion, the Rajasthan refinery capex, and so on. So wouldn't we are not really very concerned right now with balance sheet quality for the OMCs.
Sure. Since we have spoken about capital raising and the right issue, do you think HPCL and IOCL, which until now have not intended to raise equity, but may follow the plan, if at all, to secure the government grant and to be fair to the minority shareholders out there?
See, that's what we have heard from the reports that are basically circulating, that even IOCL and HPCL will come to the market the similar way that BPCL has announced it. But until there's an official confirmation, we can only speculate. As I think very clearly BPCL made it clear in their analyst interaction post the results also, that the rights issue will be a way for the government to basically fund or deploy the 30,000 crore, and that was later outlaid in the budget towards capex of BPCL. So I see no reason why IOCL and HPCL won't follow a similar pattern in the next couple of months.
Sure, Mr. Sen, since HPCL will be reporting in the numbers, your expectation more in defined way, and also the factors that you'd like to watch out for.
So we are building in about 83 billion rupees of EBITDA and 53 billion odd rupees of profits. This contrasts to about 47 0.9 billion that they reported in the last quarter, which is Q4, and just about 30 billion. But frankly, given the kind of results that have come through, I would expect that there is an upside risk to these estimates. Critical factors to look at very clearly would be the GRMs, where we, while there is a sequential decline that has been reported by by IOCL and BPCL, but the extent of GRMs that are still reported, we expect somewhere between $7.5 to $8.5 to come through for GRMs. And of course, marketing margins should actually drive a very, very strong quarter for HPCL as well.
All right, Mr. Sen, we're going to leave it at that. Thank you so much for taking out the time and speaking to us.
Thanks.
All right, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Hope it was an insightful piece of information that we suggested and the discussion that we had on All Marketing Company. Please do post your feedback for us in the comment section below. For the rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.